let's talk about investing versus trading and which one is right for you. Now, when it comes to investing, the barrier to entry is very low. Everyone has access to it, and it's super, super simple and not time consuming whatsoever. The returns, however, is where there's a little bit of an issue. On average, the S&P 500 or the overall stock exchange, on average, has returned between 8 and 11% annually. So let's say you invested $100, you would get $8 to $11 in return for the entire year. Now, investing is a long-term investment. You are investing for the future. So if you let that interest compound over time, it is the most wonderful thing known to mankind. Compounding interest is the ninth wonder of the world. And how it works is basically your base capital, the $100, plus, let's say, 10%, which would give you a new base capital of $110. 10% of 100 is $10 plus the additional base capital. Now, the following year, you are invested $110 into the market. You get another 10%. You add $11 this year. So now your 110 is 121. You see that extra bit that was added onto it? That's where the magic is. That little extra bit, that percentage that gets added to your capital and compounded interest-wise over the course of 50 years is something magical. Right here, you can see percentage gained without compounded interest. And next to it, you can see it with compounded interest. And this is over 30 years. The amount of money made due to the compound interest as opposed to without it is absolutely insane. Now, anybody can invest in the stock market. There are things called index funds, which basically mimic the S&P 500 or the NASDAQ or the Dow Jones. And it's a single asset that you can buy. And that portfolio has diversified into all of the S&P 500. So instead of you doing it yourself and buying each individual company, they allocate a specific percentage to each company and have an index fund that you can then invest into. This is how hedge funds make their money. The hedge fund has their portfolio, and you give your money to a hedge fund, and they invest it in accordance with their portfolio. Now, investing is not without risk. When I say on average, you're getting 10% returns, that's an overall average. Some years might be 20, some years might be minus 10. So you will have losing years and you will have winning years. But over time, the market has generally done this. The worst part about investing is that you are investing for a retirement fund, correct? So when you retire, you want to pull out your capital and live your life as you wish as a retiree, either fishing or yachting or whatever, sailing. Now, let's say there is a huge market crash the year that you want to retire. Your entire portfolio has then decreased and you would get out having less value than you did 2 years prior. This is where chance, unluckiness, or just bad happenstance comes into play. The timing of your retirement is relevant, and some people just get unlucky. Let's say you turned 65 in 2008, 2009. There was a huge housing crisis. Basically, your portfolio melted. It sucks. But eventually, 10 years later, it rebounded. But now you're 75. You see what I'm getting at here? Now let's get into trading and if it's right for you. Trading is a very high barrier to entry. You need to have a large knowledge base and an extended period of time where you've practiced this skill set before you can prove to yourself that you are good enough to trade your own capital in the live markets. Now, the issue with this is that I've seen traders be in this game for years and years and years, and yet they are still not profitable. So I don't know if that's due to lack of consistency or strategy hopping or just a mismanagement of funds and getting overly emotional and not having a proper strategy. But I've seen it thousands upon thousands upon thousands upon thousands of times. And to myself, I think you shouldn't be a day trader if you hadn't practiced on a demo account and can prove profitability to yourself before you enter in real capital into the markets. Once you do that, the real capital that you are trading, you should be able to outperform the S&P 500, that 10% annually, because of the amount of time that you're dedicating to your career, your job as a day trader. You should be able to outperform the market, because if you can't, then it would be much more logical for you to just become an investor and have freed up a bunch of time versus spending 40 hours a week on trading, because you're working at something to outperform the S&P 500. Whereas if you do nothing, the S&P 500 gets 10% on average, statistically, over time. So the thing that you really have to ask yourself is, one, are you willing to put in the time, energy, and consistency that it takes to become a full-time day trader? If yes, the second question you need to ask yourself is, am I able to prove that I am able to outperform the overall stock market more than 10% annually? If so, by how much? And is it sustainable long term? Can I do this for the next 10 to 15 to 20 years? If the answer is no to any of those questions, you should probably default to just being an investor. This is something that has very little time input, and you can still have a full-time job with it. So essentially, your job can pay for your day-to-day living expenses, and your investment can be for your retirement or vacation money, or however you want to allocate your funds in your personal life. This is just a quick food for thought video. Can you outperform the S&P? If so, is it worth your time? Because at the end of the day, at the end of your life, you'll think, how much time did I waste sleeping? How much time did I waste being hungover? How much time did I waste at my job? What could I have done with that time? Because the time is a expiring asset. Like, it goes away and you never get it back. And I would prefer that at the end of your time, you don't look back and regret time not well spent.